All right, everybody. Stocks by the numbers. Welcome back. And I wanted to do a quick update after hours. We had one company report, and it was pretty decent in my opinion. We had another company report, and it's pretty dismal. And the first company we'll look at here is Intel Corporation, ticker symbol INTC, listed here on the Nasdaq. As you see, the stock closed 29.05. Markets took a hit today. Stock was down about 5.5% going into earnings, and as you see, down another $5.66 right now, roughly 19.5%. Seems to be still dropping after hours. And Intel apparently, really is a shame because the stock was trending downward. And I know we looked at it recently. I said, in my opinion, technically in the numbers over the longer term, could be a good could be a good investment. And of course, it hits an 11-year low. And if we go back the last couple of quarters, the company was pretty consistent. And now all of a sudden, we're hearing basically the exact opposite type of report. And they're cutting jobs. They suspended their dividend. They're talking about a $10 billion kind of restructuring cost reduction plan, which unfortunately I kind of thought was already in place. 15,000 layoffs, and you can see we're getting basically the exact opposite story here from what we were told. Intel promises new jobs, delivers layoffs. Weak Q2 results, 15% of the workforce being laid off, 10 billion cost reduction, Q3 loss expected now moving forward. So this is just bad timing for Intel right now. And if we back it up, we have to go even further back. If we back it up, you can see stocks down here, 23.45. We're talking the end of October of 2013 was the last time we were at these levels before we started running up. And unfortunately, it seems, I don't want to necessarily blame it on the shutdowns because we had the drop. You can see we ran up to about 70, and then we had the drop down early 2020. And then it kind of rebounded basically back to where it was, and then it's just been dropping. It had a nice little recovery here, and then now it's starting to pull back. So apparently 2023 was significantly better for this company as compared to 2024. And now we're potentially starting to see that the loss of market share to other companies like AMD is really starting to hinder the performance of INTC. And it's unfortunate because, again, based on the information we had, when we looked at it not too long ago, it was like right around here. And we had a really nice run up of about 20% up to about 37. Then it started to pull back, drop below this support level going into these earnings, big red day today. And then the company just completely drops the ball. And now it pulls back to an 11-year low. And it's unfortunate because, again, this was a brand name company. They basically always paid a dividend. Everybody kind of viewed them as a staple in the tech space. And I know we were talking about how they made their reinvestment back into America, right? When Trump came in, they reinvested a couple of billion, building out a facility here in the States domestically. So, it seemed like a potential good story, in my opinion, looking kind of for this turnaround and potential future growth into 2025. And unfortunately now, this kind of just sets them back, as you see, again, pulling back to an 11-year low. And now, unfortunately, probably the next 1 to 2 quarters are going to be rough, in my opinion, for INTC. And then you're probably going to start hearing them say, oh, that cost reduction plan we did back here, we're starting to see the results now and everything's getting better and better. So unfortunately, unfortunately, we know that earnings are a toss-up and the company could report anything. And obviously the EPS miss was a pretty big negative, and the revenue, again, slight miss, in my opinion, not too crazy. But again, now you come out and say, oh yeah, by the way, we're laying off, thousands of workers. Oh yeah, by the way, we're not paying a dividend anymore. Oh yeah, by the way, $10 billion debt restructuring. It's just, unfortunately, it's just too much negativity to hit a company that was kind of already in the crosshair, if you will. You know, some people viewed it like I did when we ran some of the fundamentals, and they said, yeah, it's undervalued, you know, I could take a position. You see these little run-ups, and then the stock was kind of just starting to immediately give it back. So obviously, if you stepped in recently, you're probably down pretty big. If you own calls, you know, you might be kind of screwed here. But for the longer term investors, if you're able to hang on, there's always the possibility that the company could turn the story around over, you know, the next 2 to 3 years. But I just have a feeling that, especially now with cutting the dividend, because I feel like a lot of people, you know, remember, some of you may be younger investors and younger traders, right? So you may have only gotten into the market over the last 2, 3, 5, 6 years, which is still a decent amount of time. But again, Intel has been around for decades. And I'm sure there's people out there who've been holding shares of this company for 10, 20, 30 years. And again, for those people in that type of situation, I understand if you kind of just want to hang on to it. But also on the flip side, a lot of those older, longer term investors were still hanging on to INTC because worst case scenario, not only could it rebound, but they're still paying you a dividend. And now the fact that they took the dividend off the table, I think it's down so much now, in my opinion, because we also have longer term investors potentially jumping ship on this news after hours. So that's why, you know, I was looking, even a pullback, you know, coming down here, following along this trend line, 27s, maybe 25. And even if we pull up something like stock charts here, you can see we have a support level here at 28.11, and even second support was at about 25.5, right? So you could view that, this is the daily, by the way. So you can view that maybe as like, oh, you know, that could be the low of the low. But unfortunately, it's just too many negative catalysts at one time. And instead of stopping at something like 25.5, we're down here at 23.5, 11-year lows. The MACD steadily pulling back. The company was selling off. Look at the RSI on the daily, basically 33.25. So that's going to drop down probably to 20, sub 20 over the next day or two. And the RSI on the weekly as well was looking like it was kind of selling off and approaching that bottom 30 benchmark, and could have had a nice rally if these numbers came in, you know, robust. But of course they happen to miss, and then we have layoffs, and we're not paying a dividend, and the MACD, as you see, was about to cross to the downside on this big drop, and now stock's down 20% after hours. So that's obviously going to cross to the downside. So we may potentially, you know, if we line up even something like this, even if we go across here, you can see, even just by eye, you know, we're looking at about 22.5, 23. So I guess that's where they decided to take the stock down. If we look here in this range that we were kind of keeping an eye on before we rallied up above our resistance trend line here, connecting these tops, again, from April, looks like April 8th, 21, down to those tops there, early January 22, right? We just kind of cut that across, and you can see as the stock came up above that trend line, you had the retest, and then you had the big bounce and rally off of this trend line. And we were recently bouncing around off of it, and then we had a big run up, and now because we've broken down and we're back below this trend line, we can technically drop to the bottom of this range, as you see here, which looks like about 22.25 potentially. So in my eyes, the stock can continue to drop about another point and a half. I'm not really sure how much they can beat it up, because again, we looked at the company in the numbers, and it didn't seem like it could drop too much. I want to check. Yeah, see, even the book value per share now, I mean, you know, I understand the company was kind of hit and miss over the last couple of years, and some people were saying, no, they could bring it back, and other people were saying, nah, they're done for, they're losing market share, you know, the competitors are really stepping up, and, you know, Intel's something I wouldn't want to own right now, and obviously those people were correct. But the point I'm trying to make is now the stock is actually below book value. So this is why, again, the sell-off is justified. But again, how low it can go really remains to be seen. And if we do happen to open tomorrow, and let's just say the stock holds like 23.40 and that's where it closes. again, in my opinion, if we touch down that bottom trend line, you can see the low 22s, which would be maybe about 10% below book value. And then you may potentially see volume coming in and people saying, okay, enough is enough. We just beat the crap out of it. And now it's going to bounce back because technically it's undervalued in the numbers. And now we got to bounce it a little bit and give it some life. And, just kind of consolidate it, maybe sideways, just have it bounce up and down going into next earnings report, which apparently 14.43 billion. That seems like a big jump up in revenue, but more importantly, the company said they're going to potentially post a loss for Q3. So again, that is what seems to be really beating up the company right now. But switching over to something a little more positive, and we have DraftKings. We pull up DraftKings here, we can see we had a big drop down, then we spiked back up to this bottom support trend line here of about 36.5 after hours, and now we've kind of just been slowly bouncing upward, trying to reclaim this level. Stock closed about 35.5, down 1.5 points roughly, almost 4% here on the day. Again, big sell-off, a lot of red here, but right now after hours, you can see we're down about 0.5%, stock sitting at 35.30, and in my opinion, I really don't get it. And I appreciate the fact that some people are going to say, well, they came in light on the revenue. What do you mean you don't understand? Well, first of all, I appreciate that. And you are right, of course, technically. So on paper, it was a mixed report. So I understand the fact that the stock isn't spiking up to, 45.50 as I personally predicted. But again, I was saying if they basically report in line with the revenue, we could potentially see a positive EPS report. And if everything's in line and they report good news, potential future, improved guidance, we could really see a skyrocket. And here you can see the company delivered on the profitability side, posting 12 cents a share when they were estimated to lose just a touch below a penny. But the revenue comes in 1.104 billion on estimates of 1.113 billion. So they missed by 8.75 million. But a couple of takeaways here. First of all, in my eyes, even with the slight revenue miss, I still personally think the stock should be up. For the record, I do not have a position in DraftKings or Intel. But you can see here, revenue rises, fiscal year sales guidance boosted, $1 billion stock buyback. So we had about 875 million in revenue this time last year. We're up to 1.1 billion. And even though they reported a little shy, that's now 3 consecutive quarters in a row that this company has brought in $1 billion plus revenue, jumping up from the 700-800 million marks it used to bring in. Full year guidance, look at this, raised to 5.05 billion to 5.25 billion, from 4.8 to 5 billion. So now the low end of current guidance now is above the high end of previous estimates, which in my opinion is a very good sign. And then of course, anytime you have a stock buyback, we know usually that's a very good sign, and for the most part, stocks should be jumping higher. So again, in my opinion, if it was a perfect quarter and they beat on the revenue, the stock really should be, it would have, in my opinion, been trading at like 40, 42 right now after hours. You would have seen like a big 10, 15% pop after hours. And you can see that it kind of immediately dropped down because these numbers came in light. And then I feel like it had to bounce back to this support trend line. And then after the dust settled and everyone digested the information, this is why I say that, in my opinion, the positives outweighed the negatives. So in the immediate short term, if you have calls for tomorrow, honestly, I have no idea if the stock's going to rally throughout the day and you're going to end up going green. It's very hard to tell right now, currently after hours. However, for longer term investors, in my opinion, this was phenomenal. And they talk about, hold on. They talk about, here we go, look at this. Monthly unique payers, or users really, if you will, right? 3.1 million versus analyst estimates of about 2.5 million. And then it goes on to say the average revenue per unique player is $117 versus estimates of almost $144. First of all, in my opinion, almost $144 seems pretty excessive. But again, that's just me, right? We all live within our means. I mean, when I used to randomly want some action, I'd throw maybe like 10, $20 into the DraftKings accounts, and I would make a team that night for like an NBA game or something like that. Maybe some fights on the weekends or something, just a couple of bucks. I know there are some people out there though who have, full spreadsheets in Excel and they run algorithms and, they make, an actual career, a job out of it. There's people out there who are making, 6, 7 figures a year just off of doing, something like DraftKings. But, 117, in my opinion, still kind of decent in this economy, but technically it was a big, big miss from what analysts were expecting here. You're talking almost, like a 30-point difference there. So understandable as to why some people were a little taken back. But in my opinion, again, what I said still kind of rings true, because even though the average revenue per user was lower, look at how many more users were on this platform compared to what analysts were expecting. You're talking about 600,000 more people than what analysts were expecting for the quarter. Not the year, for the quarter. Over 500,000 more people. So again, this kind of goes back to my original analysis and theory that I put out, like over the last year or two, when I would kind of consistently just reiterate during these rough economic times. Again, people, they smoke a little more, they drink a little more, they gamble a little bit more. And you can see, yes, because of belt tightening and hyperinflation, something like the revenue per user was below estimates. But again, hundreds of thousands more users than what analysts were expecting were on this platform, taking some action, funding their accounts, taking some bets, joining some lobbies. So even though the quality of player was down, the quantity seriously surpassed estimates. And I think in my opinion, and I know you can say, well, you were kind of bullish on it, so I understand you're trying to paint it in a good light. Very understandable argument. I appreciate where you're coming from. But again, just over the longer term growth of how I'm looking at it, I do personally feel that the volume of accounts and unique payers kind of outweighs what the average person spent. Because what this really means is, more and more people are doing it. And of course, that means they're expanding their footprint and they're gaining the market share of it as well. So this is why I think, again, in the short term, I don't know, maybe they'll keep it flat. In my opinion, stock really should be up. Stock should be up, at least here, $37.5, $38, in my opinion. This miss wasn't that bad. EPS positive is phenomenal news. They raised full year guidance well above what they were previously forecasting, and they announced a share buyback, right? So this is why I understand technically we're mixed, but I do believe that the positives outweigh the negatives here for DKNG, especially over the longer term. And we can see, yeah, stock's basically flat. 200-day moving average 33.46 on the weekly. I mean, it really shouldn't. But again, if we're in the type of market now where we took it so high that any slight miss, any little negative can potentially bring a stock down, then I guess it's understandable that the stock is down. But you can see we had bottom support here, 32.70. Where did the stock pull back? Stock pulled back to about 31.45. And if memory serves correct, yep, I said in my opinion, maybe worst case scenario, you can see a pullback to this fib of about 31.34. Maybe it was like 31.60 the other day when we looked at it. Honestly, I don't remember. But you can see that that's basically where they pulled it back from, and then it had the big bounce and ran right back up to that support trend line. So this is why I say, in my opinion, some people may be selling and upset, but I feel like the bulk of investors and traders are viewing a lot of this report as positive as opposed to negative. That's why I feel it immediately rebounded here, and I personally agree with that. And now just kind of sitting sideways again. In my opinion, it should be up, but we'll see what happens over the next day or two. And you have to remember as well, this is Thursday, right? Tomorrow's Friday, with probably a lot of volume on options expiring tomorrow. So anyone who stepped in for this earnings play and grabbed 36.5, 37.5 calls, Now you're going to potentially take a loss or have that expire tomorrow, and then next week, maybe Monday, Tuesday, Wednesday, of course, after your expiration, we all know this, you may start to see the rally of the stock, and it's going to potentially climb back to the high 30s and low 40s now on this upcoming week. Which is why, again, I always say, in my opinion, if you are going to, step into a company a couple of weeks before earnings, time is king. And that's why a situation like DraftKings, we don't know, even if we get a good report, we don't know necessarily that a stock is going to pop 5-10% guaranteed, right? Nothing is guaranteed. So that's why a situation like this, if the middle of July you wanted to step into DraftKings and play it after earnings, right? In my opinion, instead of buying 8-2s expiring tomorrow, trying to catch that immediate pop, hopefully, you buy a little bit more time, and of course it's more expensive because they expire after earnings, right? They know what they're doing. This is why they charge you more money, because now they know, okay, it didn't happen right away, and we may have options expiring on the 2nd tomorrow, but now the further out calls going out to the 9th or the 16th, those are going to potentially make money, because after we expire again, the calls immediately after earnings, now the stock can find its footing and start to rally the week and 2 weeks after that earnings report. But, again, this is why earnings are rough, because it all comes back to, hindsight, and you start to question yourself, oh, I was going to buy puts, but I decided to buy calls, and I knew I should have bought puts. Like, it's a big gamble. It really is a big gamble. So, all of you longer term investors out there, if you're jumping ship on something like Intel, in my opinion, I understand. Longer term investors on something like DraftKings, in my opinion, I would hang on, because again, I personally feel it was definitely a more positive report than negative. And unless markets really continue to drop hard, something like DraftKings, in my eyes, should really kind of hold up. But again, this is why we say earnings are a gamble. Please understand the risks involved. And if you have a small account and you're not really able to fund it too much, if we're talking you have like a couple of $100 or just like a couple of $1,000, in my opinion, something like rolling the dice on an earnings option call or put really isn't the way to do it. But again, that's just my opinion. Even before earnings, again, when it dropped down, I said, overreaction, and if you could buy some calls with some time, you should be good. And you can see how they bottomed it out and then they rebounded it, right? Very similar to what we saw when we had PM sub 90, and then it slowly rallied back to the high 90s, back to 100 plus, right? Look for those big dips and then buy yourself some time and ride the rebound. In my opinion, I feel like personally, anyway, for me, it is much easier to make money with that type of strategy as opposed to just saying, oh, Intel's reporting earnings today, I'll buy a call. Screw it. I want some action. It's unfortunate because we do want the action, because now everyone just posts their big gains. So then if you take no action, then you're sitting there, oh, I knew this was going to happen. Oh, look, this guy made 700% returns. I should have played it. I had some cash. Like, remember, there are stocks that move big every day in both directions. And it is impossible for you to probably have enough capital to play all of them and get, 70 or 80% of those calls correctly so that you're not just bleeding money and you're actually growing your account. It's much more difficult than people say it is, and like they say, if it was easy, everyone would do it. And again, everyone is currently doing it, but the average person still loses money, right? People forget that. And this is why I say sometimes you got to work smarter than harder. But for you guys who had a couple of bucks to roll the dice, obviously, it's kind of a crapshoot, 50-50 chance with earnings, Intel down, DraftKings not moving. So on these two companies here, unless you had Intel puts, you probably have no reaction, and probably going to end up taking a loss if you have tomorrow's expiration. But again, I just want to remind everyone, even if you did take one of these positions and you're going to potentially get it wrong and take a loss tomorrow, you know, it's unpredictable again because it's earnings, but I will say, you know, just try to do your best to, you know, learn from the experience, take something from the experience, and just try to implement something moving forward, right? Try to take something from it. But yeah, that's pretty much it. I talked for too long, so I'm gonna end it there. Well, I did want to look at the Bollinger Bands though again, real quick for DraftKings, and yeah, we're down here 35 and a quarter. Bottom Bollinger Band on the daily, 34.87. So maybe, you know, they bring it down a couple of cents and then try to bounce it back to the mid Bollinger Band of about 37. MACD basically flat with a pop after hours here. We could have crossed back to the upside, but again, some moves after hours aren't necessarily where the stock looks pre-market and after market open, right? So we can wake up tomorrow and DraftKings could be up 2.5%, 3%, and then markets open and it just, you know, steadily kind of slowly keeps growing throughout the day. So we don't know yet how it's going to open and how it's going to perform tomorrow, but switch over to weekly again real quick, and bottom Bollinger Band 33.10, 200 day, yeah, 33 and a half. Stock currently sitting up here still in the 35. So again, right now, not an immediate reaction, but we'll see how it opens and starts trading tomorrow in the AM. And, you know, maybe we can update it going into next week and see if the stock, you know, bottoms and starts to rally like we said, maybe over the next week or two. So we'll come back to it, but that's pretty much it. So I'll end it there. Once again, Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually pretty quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky, they're volatile, and they're very uncertain. So I want to wish all of you success. Hope everyone makes a couple of dollars. Thank you for your time. Have a good day.